Hey guys, welcome back to Dome Talks. Today, before I even get into anything, I want to say a massive kudos to Trading 212. I made a video a couple of weeks ago about basically saying how I wasn't so keen on the way that they, I suppose, presented whenever they paid a dividend and not letting investors know that if you purchase an American stock, you actually pay a 15% withholding tax if you're in the UK. And actually, to my surprise, on some of the recent dividends I've been seeing on the notifications and on the statement, it now tells you that you do pay that 15% withholding tax. And so I just want to say, cool, keep it up. And anyway, back to the video. So today we're going to basically discuss capital gains and how to calculate them through an example that I'm going to show you. If you're new to this channel or just first time listening, this whole channel is all about investing and personal finance and actually trying to create as many practical tools and practical advice to give to people rather than just theory. And it's through them tools or advice, it's kind of hoping to make things simpler. So today is one of them examples. So let's take a look and work through it. So before we go into the example, let's lay out some key things. What is capital gains tax? Now, capital gains tax is basically the amount that you have to pay tax on in the UK for selling stocks and shares that are not in the ISA wrapper. So they're a chargeable gain, and therefore I have left a link at the end of the video on basically how you can avoid this tax and start investing through an ISA, which will mean you won't pay any capital gains. But for those people who maybe have already topped up their ISA and looking investing still, then you will be liable for capital gains whenever you sell a share and make a profit. So next on the assumptions is basically we are going to assume that whenever we buy these shares, we're going to hold them for a long term because we are value investors. Now, when I say long term, I mean in this scenario of at least over 30 days, and we do not sell any shares on the same day. So in the examples that I'll talk through, we just assume that we might hold them for months or whatever, or years, and therefore we calculate the capital gains off of that. So without further ado, let's actually get into it now. So here I've listed out some transactions basically of us buying and selling throughout the year in this company, which we see as being massively underinvested and way below its intrinsic value. So in April, we basically say we buy some 50 shares at £80 a share, and therefore our cost of shares is £4,000. Now on UK shares, we have to pay stamp duty land tax, which is like 0.05%, which basically equates to £20, and then we've got a commission charged by our broker, in this case of £3, and therefore our total cost is £4,023. Now we do the same again after we get paid in June, and this time we only buy 20 shares at £90 per share, and therefore the cost of them shares is £1,812. Now if we take a total, that means that we've now got 70 shares, which have cost us £5,835, which you can see here. Now, in October 21, we actually see that the price of the share price has actually really increased, and we actually have an opportunity to sell it at £120. So we think, okay, we'll take some out and we'll bank some of the benefit. So we sell 20 shares in October, and therefore the way that we actually calculate the total cost is by taking the average cost. Now, as you can see here, what you do to get that average cost is you basically say you take the 5,835 and you multiply that by 20 shares that you're selling over the total amount of shares that you've got. So it's 70. So 5,835 times 20 over 70, which basically means that we've got 1,667. Now, that's the total cost. So for our transaction one, if we look down here, we basically said that we're going to sell 20 shares at a share price of 120. So our total revenue is 2,400, and brokerage has actually charged us again a £3 charge, which we're just assuming, and the total cost is the 1667 that we just calculated up here. So therefore our chargeable gain on the selling of them shares is £729.86. Now in the UK the current band is 12,300, so we're quite a bit off of actually utilizing that and then being liable to actually pay pay tax on it at a rate of either 10% or 20%, depending on if you're a basic rate earner or a higher tax rate earner. So sounds simple, but now what happens if we start like mixing it further and we actually do some more buying and selling? So say after we sold them shares in December, we see that the price actually drops down to £90 again, and so we decide to buy 10 shares. Now them 10 shares basically means that, again, with the stamp duty, land tax and the commission, our total cost is £908. So therefore our revised number of shares is 60 shares that we've got in our pool, because we carried 50 forward from when we sold the 20 shares. So we've got 60 shares sold, 60 shares now, and that is a total average cost of £5,075. Now in March, when we're coming to the end of the tax year, we think, well, we'll try and utilize some of the banding, because again we've noticed that the stock price has jumped again to £150. Now, so this time we actually say we're going to sell 20 shares. Now, the way that we do this again is that we basically say we take the average of the cost. So again, it's the 5,075, which is the new total cost. And then because we do the 20 shares that we're selling over the total amount of shares that we've got in our pool, so that's 60. So that therefore gives us a revised cost of 1,692. Now, if we plug that into the formula here, we basically, again, selling 20 shares at a share price of 150. Therefore, our total revenue is 3,000. And again, transaction fees by the broker for just selling the shares is £3, and then our cost is the 1692 up here. So our total chargeable gain is 1,305.21. So I hope that makes sense to you guys, and I think it's just as simple as that. So let's go back. Okay, I hope that made sense to you guys, and I hope it helped. If you do want to see an example of when we actually sell the shares within 30 days and how that kind of affects us on the tax calcs, then drop a comment below and like and subscribe to the video, and I'll be sure to do one. But thanks again for watching, and appreciate all the support. Also guys, if you are interested in opening up an ISA, we're fresh to the new year and you can avoid all the hassle of calculating any capital gains by just opening up this account with Trading212, which I've left the link below, and we will both get a free share, and half of my share will go to charity. So what's not to love? All for a good cause. All right guys, definitely catch you later. Bye.